Now let's get going. Bret Bertolin, I would like to invite you up to come and join us. He is first in our journey today. I am so pleased and honored to be introducing him. He is bringing his expertise as senior economist of the Washington State Economic and Revenue Forecast Council. He is going to unearth for us those mysterious seeds that produce our national and state economic forecasts. Welcome, Bret. We are so happy to have you here with us today.
So we just completed our March update of the economic and revenue forecast, and the November update, in terms of the economic forecast, there was very little change. We expect slowing growth. We do not forecast a recession. Wage growth and inflation remain moderate. Downside risks, well, you can read uncertainty regarding trade and fiscal policy, geopolitical concerns, and a maturing economic expansion. We have not factored in the potential impact of the 737 MAX grounding. So in terms of labor markets, the unemployment rate, the unemployment claims, also job openings, all show a great deal of strength. So we follow two measures of consumer confidence. Both remain strong for now. This is a measure of small business confidence from the National Federation of Independent Businesses. And while it's dropped off recently, the level is historically pretty high still. And as I said before, the labor market nationally and here remains very strong. The job growth or openings is rising very rapidly. And the Washington and U.S. unemployment rates are at or below the pre-recession levels. Washington personal income growth has led the nation for the national average for the last 7 years. The last 2 years, Washington personal income growth has been the highest of any state. And if you look at a lot of other measures, job growth, GDP, and population, things like that, all show Washington outpacing the U.S. Here's average monthly employment growth. So this is pretty much to scale. Washington's about 1/50th of the country. So even though we see that Washington job growth has slowed some in the last couple of years, the 6,000 per month average last year would have translated nationally to about 300,000, which would be considered quite strong. I don't know what W1 and W2 are, and I don't know what happened to my percentages, but you could, on the bars. So this compares job growth between the U.S. and Washington over the last 12 months. And there are two areas that obviously really stand out. So one is information. There was barely any growth over the year. Information in Washington is quite different from the rest of the country. For one thing, there's a very large software industry and it's growing. But increasingly in recent years, it's also including other IT services such as internet publishing and web search portals, for example. The other sector that looks quite different in Washington is retail trade. Retail trade statistically includes electronic sales, and Washington has a very large and very rapidly growing industry there. Wage growth, generally, in the past few decades, wage growth has been growing fastest for the people with the most education and slowest for the people with the least education. In the last year, both groups have grown about 3.3%. Exports, this is Washington exports. Exports to China have declined in each of the first three quarters, last three quarters, 2018. This is also exports broken down by type of export. We had our first year-over-year decline in quite a while, in about a year. It's mainly due to a big drop in agricultural exports. Home price growth, I'm sure most people from around here know that prices have been growing rapidly in the Seattle area. This compares it to the US, and you can see it widening quite a bit before dropping off at the end. So for the last this is year-over-year growth. For the last 6 months of 2018, seasonally adjusted prices actually were declining, and now we're at a point where the year-over-year growth is about the same as the US. This chart shows residential permits per 1,000 population. Washington, so it's a per capita basis, so it's the same scale. Washington is usually higher, and that's because our population is growing more rapidly. So one warning sign we have about a slowdown coming is retail sales, which you can see the growth rate has dropped quite a bit recently. Business investment, a little bit of a drop too in the last few months. Economic, the leading indicators have declined a little bit, but not so much that they are warning of a recession in the near future. So, on the subject of recessions, normally short-term interest rates are lower than long-term interest rates. When the opposite is true, that's called an inverted yield curve. And this historically has been a pretty good indicator of recession. Now, the recessions don't start right when they invert. It might be a year or so after that. But just recently, in the last few days of March, the yield curve did invert. So you can see by the red circle at the end. Just barely, but it is negative now. This is the results of the National Association of Business Economists. They were asked when they thought the next recession would start. More chose 2020 than any other year. If you add the first two columns together, it's more than 50% within 2 years. Now, we also get the individual members, over 50 people in this survey, annually for 2019 and 2020. And even though they think there's likely to be a recession, not one of them predicted negative GDP growth in either of those years. This is similar, a different survey, Wall Street Journal economist survey, and their estimation has grown over the last year and now shows about 25% chance of a recession starting in the next 12 months. We also asked our Governor's Council of Economic Advisors what they thought, and their average was 36%. So, NAIRU is a non-accelerating inflation rate of unemployment. So, a lot of people would call it full employment unemployment or the natural rate of unemployment. This chart shows that historically recessions are preceded by the unemployment rate dropping below the NAIRU rate. And I say almost always because in the back-to-back recessions of the early 80s, it didn't drop below the full employment unemployment rate for that second spike of the back-to-back recessions. But a lot of people consider that one episode, so in that case it would be always. So now I'd like to present some data that came from macroeconomic advisors. They did some analysis of the likelihood of inflation based on data collected since World War II. So the first one shows an unconditional probability of recession in a certain year. So by unconditional, I mean the odds within the next year have nothing to do with what happened last year. So like a coin flip, if you flip a coin 3 times and get heads, your chance of getting heads next time is still 50-50. And as you can see, the unconditional probability starts off at maybe 20% in the first year, and then it declines gradually. The cumulative is just adding up all of the annual probabilities. So that approaches 1. Eventually, we will have a recession. So the interesting thing about this study that they did was looking at what happens when the unemployment rate is low, like it is now, compared to when it's above the NAIRU rate. And they took the recessions, divided them into 2 groups. And when the unemployment rate is above NAIRU, which it was until just recently, you can see the first and second year particularly, pretty low chance that you're going to have a recession. But when the unemployment rate is below NAIRU by at least 0.3%, which it is, then those near-term probabilities are much higher. These are just the cumulative probabilities. So when the unemployment rate is low, that's the, I don't know if it's, I guess it's green. I have trouble with green and blue. You have a fairly significant chance, maybe 30% or so, that you would have a recession within the first year. And within the first 2 years, it's more than 50% by that model, as opposed to when the unemployment rate is high, the near-term recession is much less likely. So if there is a recession soon, we shouldn't take too much comfort from the fact that, that the local economy is booming compared to the US. This shows that the rise in unemployment in Washington usually is about the same as the rise in US unemployment. So Washington was growing faster than the US going into the last recession. It didn't stop the unemployment rate from rising about the same as the US. And I remember back in the 90s, early 90s, that recession, there was almost no decline in employment at all. But you can see then there was an increase about the same as the US. And the reason for that is that there was also a lot more population growth, so therefore labor force growth. And this is my only revenue slide. So this shows what might happen with a typical recession, not like the recession we had in 2007. And we produce an optimistic and a pessimistic forecast as well as our baseline forecast. So that pessimistic forecast has a recession in it. And revenues for the biennium are about 5% lower than in the baseline forecast. And you can also see those probabilities, 35% pessimistic, 15% optimistic. And those are subjective, but that's indicating that we think that risks are mostly on the downside. So real GDP growth has slowed from very strong in the second quarter, and we expect growth to continue to slow. And this compares our forecast with others. Ours is the ERFC bar, but that's also the blue chip average of 50 or so business economists, because that's what we use to guide our GDP forecast. But we also compare it with IHS Market, the Federal Reserve, economy.com. They all show declining growth in future years. So, I think I mentioned at the top that the forecast, the economic forecasts, were really very little changed, and so you can see that here. Actually, the GDP forecast is lower. It's hard to tell. So we expect GDP growth to slow from 2.9% last year to 2% by 2023. Our oil price forecast is just slightly weaker than in November. Now, probably the only significant change in our forecast is a more dovish monetary policy. In November, we expected 2 25 basis point rate increases in 2019 and 2 more in 2020. Now we've cut back that to 1 increase in each year. And that may still be too high. So again, national here, you can see again how close the forecast is to the last one. We expect national employment growth to slow from 1.7% last year to 0.6% in 2023. Now, the main reason for the slowdown there too, really, there's a cyclical, we're pretty much at full employment already, so we don't have that ground to gain, and also we're looking at much slower labor force growth due to demographics. Washington personal income also almost unchanged. We expect income growth to slow from 6.9% last year to 4.7% by 2023. Hard to see the slowdown there, but there is one. And Washington employment, also almost unchanged, and we expect growth to slow from 2.5% last year to 1.0% by 2023. So that's still, outpacing the U.S. employment growth by about 0.4%. So this is actually electronic shopping and mail order. Mail order is almost non-existent in Washington. We have experienced very rapid growth in the last few years. We expect it to slow in the future, but continue to grow in Washington. Permits are also very similar to what they were in the last forecast. We expect them to decline slightly from current levels. And in conclusion, so the economic forecasts are only slightly changed. Washington economy is continuing to outperform the nation, but not as dramatically in the past. And the level of uncertainty in the baseline remains elevated, with downside risks outweighing upside risks. Thank you.